my first guess says that once the post-election sugar high wears off, this market's going to play out in two phases. I want to bring in our Wall Street Alliance Group partner, Aadil Zaman. Aadil, welcome back to the show. All right, so let's talk about phase one. As the sugar high goes away, you're saying businesses scale back, consumers scale back, and that means the market pulls back.
Yes, absolutely. I think once the sugar high of the stock market wears out, I think what people, consumers and businesses, what they're going to do is they're going to wait and watch. And they're going to wait and watch to see how the new policies turn out, how the new taxes turn out. And I think because of that, we will see a long-awaited pullback in the first half of the year.
So here's the thing. Yesterday, we saw the New York Fed where it does say that consumer spending is down now to levels we hadn't seen. Expected spending growth is starting to slow down. The flip side of that this morning, NFIB, the enthusiasm, the confidence thing shot through the roof. You know, it's one of these worlds where you can only afford, particularly from a business point of view, to put it on pause for a certain period of time.
Yes, so we think that in the second phase, we are going to start getting the trifecta effect, where we get lower rates, low taxes.
Before we get to that then, let me ask you, first half 2025, if we get this pullback you're talking about, what do you do with your positions in the market? We just talked about how these super duper hot stocks hit a big speed bump yesterday. You start to scale out of those kind of names?
What you want to do is that you want to increase the breadth of your portfolio right now to reduce your downside, and you want to go for areas that are going to benefit from the Trump's new policies.
All right, so let's talk now phase two. Phase two, these policies will be lower taxes, lower rates, less regulations. You add them all up, and you get a stock market rally in the second half of the year. Absolutely.
So second phase, we feel that this trifecta effect is going to go into place. Low rates, low taxes, less regulation, pro-growth, and that's going to take the market up. And in that era, you want to be invested in broader exposure to the market, not just overly invested in the big tech.
So let's talk about that because, you know, it's so weird to me that we've been talking about this for a while, like, and a lot of strategists have come on the show, let's say the last 6 months, and saying exactly what you're saying. Get out of big tech, ease out of it, cut your exposure. And it's good to say that, but in reality, if people had done that, they might have missed out. I showed App Lovin'. You might have missed out on 800%, right? These are once-in-a-lifetime moves. So you get out of them prematurely when they're running like gangbusters to say, hey, I want to be balanced in something like real estate stocks that may not be moving?
Well, I think what we've started to see is that other sectors have started to pick up. Like financials are pretty hot right now. You know, they're going to benefit from less regulation, low rate cuts, lower rates, greater investment banking activities, you know. So I think what you want to do is not get out of the big tech completely. You still maintain the exposure.
So keep some exposure.
But diversify into other areas.
There's something in your note I thought was interesting. You talked about active management.
Yes.
Active management. So here's active management, the percentage of active managers that have outperformed the stock market. So year to date, when it comes to equity, is only 59% have actually underperformed. 59% have underperformed. Internationally, it's 70%. The 10-year average, 85% typically underperform. Why is now the period, this era, you say, where active management will turn this around?
We're entering a very different phase in the market right now with the elections, with Trump being there. I think what we are going to see right now is if you're just invested in the S&P 500, you're more than 40% invested in tech. So now you want to be active. You want to diversify, you want to add exposure to utilities, financials, and energy. Those are the three sectors that we think are going to do well in this new Trump era.
The financials hit all those boxes we talked about, right? It should work. And by the way, fundamentally, they look inexpensive. This checks all your traditional valuation metrics and ways of picking stocks. Utilities might be expensive in terms of, you know, where utilities normally trade. These two, this is also sort of a beneficiary of the tech boom as well, though, right?
Yes, absolutely. Because utilities, we've spoken about it on the show at length. But with Trump coming in, because of artificial intelligence, is going to do well because of less regulation and more capital expenditure. So artificial intelligence does well. That consumes a huge amount of electricity. So because of that, we think utilities will continue.
Oil and gas, though, doesn't move. Is this just, I mean, honestly, just, you know, we've had, and you hate to say it, but this is the kind of thing that used to move on geopolitical news. It really, the needle does not move. You would still be invested there? I mean, I can understand maybe like in the risk-reward part of it. Not a lot of risk, perhaps, but when does it spark? What takes these names higher?
I think that in this new administration, we are going to get we are going to see deregulation in that space. We are going to see more drilling projects.
I got
and we are going to see big oil companies do extremely well, and they are trading at relatively low valuations and pay a good dividend.
All right, my man. Good stuff. Adele, really appreciate it.